Hello and welcome to HomeCapital's series on home ownership. Buying your first home can be a daunting task, and in this series we simplify the entire process from the various factors that you should keep in mind before you decide to buy a house, the process that you can expect when you are buying a house, and finally the various responsibilities that you will have as a homeowner. Now, what do we mean by your risk-taking capacity? The risk that you're ready to take with respect to your investment is generally governed by your ability to take risk and your willingness to take risk. The ability to take risk is governed by a number of factors which include your age, which include your earnings, which include how much surplus you have managed to put aside each month, and also the goals that you have in life. So if you see that if by the age of 50 you are paid off your home loan and you have a house which is in your name, which is valued at a good amount, it allows you to take more risks with your investments. It improves your ability to take risk. Versus if at the age of 50 you're sitting with a huge home loan outstanding, it directly has an impact on your ability to take risk. Willingness to take risk is a function of your personal behavior or personal choice, and to a certain extent, when you don't have your home loan outstanding against you, it would definitely improve and help your willingness to take risk also. And with the improvement in your ability and your willingness to take risk, you can look forward to a portfolio from which you can expect higher returns. Going by the principle of high risk, higher returns, low risk, low returns, today you have a house where the home loan is paid off and you have a higher ability and willingness to take a risk, and that should in turn translate into higher returns on your portfolio investments. And as your portfolio grows, as you're able to accumulate a good amount of corpus for yourself, you can contemplate what everybody loves to get into, which is an early retirement. The two major benefits that you get is, since you bought the home when you were 25, by the time you're 50, you've cleared off your loan. You're cleared off your loan and you can actually contemplate taking early retirement because you do not have any liability outstanding against your name, right? Not only have you paid off the entire EMI in the home loan, but you have no more worry about a rent expense because you live in your own house and you can take the decision to retire because you don't have a rent expense to worry about. And if you want to generate additional income, you can always give the home, which is your home today, which is 100% equity belongs to you. You can always give that on rent to generate an additional income for yourself. If your house is in one of the metro cities and you plan to retire and shift to a smaller town, the rental income that you'll generate from this house is going to be much higher than from a smaller place, and that gives you an additional stream of income. You also have the option to reverse mortgage your house, as a result of which the house becomes an income generating asset for you. By having 100% equity in a home, by the time you're 50, it gives you an option to decide to retire early, and it becomes a backbone for your retirement. Now that you understand the innumerable benefits associated with taking the decision and the plunge to buy a first home early in your career, let's look at some of the things you must consider before you actually take the decision to buy the house, right? From a financial point of view, you must first ensure that you create an emergency fund for yourself. The emergency fund should be at least 3 times of your monthly expenses, and if you live with a family, it should go up to 6 times of your monthly expenses. What you should keep in mind is it should be invested in liquid funds or in fixed assets, and this fund should not be touched. You should not land up taking the emergency fund and using it to pay for the down payment of your house or using it to decorate your house. This is a fund to be used only in case of emergencies, and you should set up an emergency fund equal to 3 to 6 times of your monthly expenses and put it aside to be used in a rainy day. Once you've set up an emergency fund, you need to ensure that you have adequate life insurance and adequate health insurance for yourself, because these are the two most common emergencies you will face, and you need to have a protective cover for it. Have a term insurance plan which is equal to 12 to 15 times your annual income, which ensures that if anything were to happen to you, you are replaced financially for your family and they do not face a financial burden in your absence. Have a health plan for yourself and for your family members The amount of cover you take will be a function of where you live. If you live in the metro cities or in the tier 1 cities, look for a higher health insurance cover that will take care of any medical emergencies that may arise. The unique thing about insurance is the day you need insurance the most is the day nobody is going to be willing and ready to sell that product to you. That is why you need to take the decision to have a life insurance and a health insurance product well in advance today when you don't think you need it. In addition to setting up an emergency fund and having a life and health plan, ensure that you pay off all your debts, especially your high interest credit cards. The reason being, credit cards come with an interest rate ranging from 24 to 36%. There is no reason you should be carrying them. If you have any high interest personal loans, repay those loans also. A car loan is something you can consider whether you want to keep it, or if your finances allow, go ahead and repay your car loan as well. At the end of the day, you need to keep in mind that your EMIs towards your loans, that is your home loans as well as your car loans and any other loans that you have outstanding, should not exceed 50 to 60% of your take home income. So before you decide to buy the house, you should map out the various reasons of why you are buying a house, consult a HomeCapital expert, check your finances, figure out the down payments that you have, the home loan that you can afford, the budget of your house, and start exploring your neighborhood. Let's close this episode with a quick recap of the benefits of buying a house early, which have a tremendous impact on your financials over a long period of time and improves your risk-taking capacity, and the fact that you must create an emergency fund, have a life insurance and a health insurance and plan, and pay off all your debts which are outstanding as of today, all your high interest debts, so that you start off on a clean slate. In the next episode, we will go ahead and talk about how you should select your house, the various factors which will affect you in deciding the property where you want to invest your money. The HomeCapital community assists and guides you successfully through your journey of home ownership. Join India's first community of home buyers and homeowners and take your next step towards home ownership.